Bitcoin, no longer long only? If not, how should Bitcoin traders position themselves? Year-to-date, Bitcoin ETF inflows stand at just plus $225 million, and they could turn negative at any moment as the ongoing uncertainty surrounding Trump's trade war continues to ripple through financial markets. Bitcoin ETFs are on track for their third consecutive month of outflows. As we highlighted in early February, much of the initial ETF inflows were driven not by outright demand, but by arbitrage-focused hedge funds. Recent flow data has primarily confirmed this view. However, a new class of buyers has also emerged, one that has had a meaningful impact on the market. The key question now is whether this buyer is returning, and if so, does that justify a broadly bullish outlook? As noted, Bitcoin ETF flows have remained weak due to funding and basis rates staying below the key 10% hurdle rate. However, those rates have begun to tick higher. As we highlighted 2 weeks ago, historical data shows that when the funding rate turns negative, there's a 77% probability that Bitcoin trades higher 3 to 6 months later. While this isn't a short-term timing tool, it does suggest a potential upward bias from the level at which we published that analysis, $87,522. Of course, no statistical model can account for trade wars, nuclear threats, or alien invasions, so we remain focused on the key market dynamics typically associated with bullish environments. Ultimately, however, it all comes down to identifying the marginal buyer. Following Elon Musk's endorsement of Donald Trump on August 8, 2024, wallets between 100 and 1,000 BTC increased their holdings from 3.9 million to 4.6 million BTC. That net inflow of 700,000 BTC made them the largest wallet cohort. While the original, OG wallets, 1,000 to 10,000 BTC, gradually sold into the rally, it was this mid-sized group, likely made up of family offices, asset managers, and possibly even tech billionaires aligned with Musk and Trump's pro-crypto stance, that drove much of the upward momentum. However, those buyers have since paused their accumulation, and without a clear, dominant marginal buyer in the market, a breakout seems unlikely. For now, Bitcoin appears poised to remain in a broader consolidation range. This is why, despite our cautious optimism, we view Bitcoin as trading within a broad range of $73,000 to $94,000, with a slight upward bias. During the recent correction, Bitcoin approached the lower bound of its trading range. While short-term technical indicators have improved, the broader market structure remains weak. Retail trading volumes remain near their lows, which not only suggests continued underperformance for altcoins, but also limits Bitcoin's upside potential due to reduced retail-driven momentum. Limited fiat inflows, as seen in muted stablecoin minting, suggest that the recent positive momentum may be short-lived. Bitcoin's rally over the past year hasn't been driven by typical crypto bro speculation, but by long-term holders seeking diversification and adopting a buy-and-hold strategy. These investors are not actively using Bitcoin for transactions, and unlike previous cycles, the growth in new network addresses has slowed significantly. This doesn't necessarily imply that prices will fall, but it does suggest that the current wave of buyers is focused on storing Bitcoin rather than circulating it. Overall, on-chain data remains subdued and continues to signal more of a bear market environment than a bullish one. Monthly cycle indicators, such as the stochastic oscillator, further support this, showing patterns more typical of a market top or late cycle phase rather than the early stages of a new bull run. As a result, short-term signals are not aligning with longer-term indicators, highlighting the disconnect in the market outlook. Our preferred strategy has been to sell puts to capture premiums, particularly with elevated implied volatility, which offers attractive yields. This has been our consistent view in our April 1st and reiterated in our April 2nd report. Bitcoin and tariffs, How to position for what comes next. Note: we prefer selling puts into a gap lower in risk assets, taking advantage of elevated implied volatility and skew. With strong support near $73,000, the setup reflects a minus 10% downside versus plus 20% upside, perhaps not ideal, but reasonable, particularly when collecting premium through put selling. In an uncertain environment and lacking a strong bullish macro driver, selling puts and calls allows traders to benefit from range-bound conditions rather than betting on directional moves. Unlike the near-zero funding premiums currently seen in basis trades, option implied volatility continues to offer relatively attractive yield opportunities. Instead, we expect Bitcoin to remain within a broad trading range, making the strategy of selling calls and puts to capture premium particularly effective, especially as Bitcoin approaches the midpoint of that range, $73,000 to $94,000. Once again, Bitcoin is no longer a parabolic long-only retail-driven market. It now demands a more sophisticated, finance-oriented approach. Traders must be able to seamlessly shift between high-yield income strategies, selling options, funding rate arbitrage, directional bullish positioning, and capital preservation. Success requires a broader and more adaptable skill set in this new environment. Collecting premium through option selling is one of those skills.